Something is happening in the bond market right now that should terrify every American who owns a home, carries credit card debt, or plans to retire in the next 20 years, but almost nobody is paying attention. They are distracted by headlines about tariffs and political drama while the Federal Reserve quietly signals that everything you have been told about rate cuts is wrong, dead wrong, and the implications for your financial future are severe. Let me show you one number, 95.9%. That is the probability, according to CME FedWatch data released this week, that the Federal Reserve will not cut interest rates in March. Not probably will not cut. Not likely will not cut. 95.9% certainty that rates are staying exactly where they are. The probability of a rate cut is just 4.1%. That is not a maybe. That is the bond market telling you in the clearest possible terms that rate relief is not coming, not in March. And based on what Fed officials are saying right now, maybe not for a very long time, I am Kenzo John AG, and this is Market Acme. For the past 6 months, Wall Street has been selling you a story. They told you that inflation was coming down. They told you the Fed would start cutting rates aggressively in 2026. They told you that your mortgage rate would fall, your credit card interest would drop, and the cost of borrowing would finally return to normal after years of pain. Financial advisors told their clients to wait for rate cuts before refinancing. Real estate agents told buyers that prices would rise once rates came down, so you better buy now. The entire market has been positioned for a pivot that the Federal Reserve just told you is not happening. And here is what makes this so dangerous. Markets are still pricing in roughly 3 rate cuts this year. 3, despite the 96% probability of no cut in March. Despite Fed officials explicitly stating that cuts are not appropriate right now. Despite inflation data showing prices still rising faster than the Fed's target, the disconnect between what markets expect and what the Fed is actually signaling is enormous. And when that gap closes, when reality finally catches up to expectations, a lot of people are going to lose a lot of money. Let me show you exactly what is happening because the details matter. The yield on the 10-year Treasury just stabilized around 4.05% after coming under pressure earlier this week. Now, 4.05% might not sound dramatic to you, but let me explain what this number means for your life. The 10-year Treasury yield is the benchmark for almost every form of borrowing in America. Mortgage rates are priced off this yield. Corporate bonds are priced off this yield. Auto loans, student loans, business lending, all of it flows from this one number. When the 10-year yield stays elevated, borrowing costs stay elevated for everyone, for years. And right now, the yield is stabilizing because the market has finally accepted what Fed officials have been saying all along. Rates are not coming down anytime soon. Fed official Susan Collins stated this week that maintaining current rates is likely appropriate given an improving labor market and persistent inflation risks. Thomas Barkin added that monetary policy is well positioned to manage economic risks. Austin Goolsbee, the Chicago Fed president and a voting member of the Federal Open Market Committee, was even more explicit. He said rate cuts in the near term are not appropriate until there is more evidence that sticky inflation is declining. Let me repeat that. Sticky inflation, that is the word he used. Sticky, meaning it is not going away, meaning the price increases you have experienced over the past 3 years are not temporary, they are embedded in the economy. And until that changes, until inflation actually falls back to 2%, the Fed is not moving. Goolsbee said it directly, quote, "I remain optimistic that there can be more rate cuts this year, but that hinges on seeing actual progress on inflation that shows we are on a path back to 2%, end quote. That is not a promise of rate cuts. That is a conditional statement full of uncertainty. He is saying maybe there will be cuts if inflation cooperates, but right now, inflation is not cooperating. The most recent personal consumption expenditures data, which is the Fed's preferred inflation measure, came in at 2.9%. That is up from 2.8% the previous month. It is not falling, it is rising. And it is still nearly a full percentage point above the Fed's 2% target. The Consumer Price Index showed a similar picture. Overall inflation dropped to 2.4% in January from 2.7% previously. That sounds like progress until you realize that core inflation, which strips out volatile food and energy prices, is still at 2.5%. And core is what the Fed actually watches because it shows the underlying trend. Here is what this means in practical terms. The Fed has a dual mandate from Congress. They have to balance full employment with price stability. These two goals often conflict. Lower interest rates support hiring and economic growth but can fuel inflation. Higher rates cool prices but can weaken the job market and cause recessions. Right now, the Fed is stuck. Inflation is above target and proving sticky. The labor market is resilient but showing signs of what Goolsbee called low hiring, low firing dynamics. That means companies are not laying people off, but they are also not adding new jobs. The economy is frozen in place, and the Fed cannot cut rates without risking inflation acceleration, but they cannot raise rates without risking recession. This is the trap, and you are caught in it. Let me show you how this trap affects your daily life, because this is not abstract economic theory. This is your money, your mortgage, your credit cards, your retirement savings. When the Fed holds rates steady at 3.50 to 3.75%, as they did at their January meeting, every form of consumer borrowing stays expensive. The federal funds rate directly influences the interest rates you pay on credit cards, home equity loans, auto loans, and adjustable rate mortgages. Right now, the average credit card interest rate is above 20%. The average 30-year mortgage rate is hovering around 6.5 to 7% depending on your credit profile. Auto loan rates are between 7 and 12% for most buyers. None of these numbers are coming down. Not in March, when there is a 96% chance of no cut. Not in April or May based on current Fed guidance. Maybe June or July according to market forecasts. Maybe December. But those are guesses based on assumptions about inflation falling that have not materialized yet. And if inflation stays sticky, if prices keep rising faster than the Fed's target, then even those distant rate cut expectations will be pushed further into the future. Let me put numbers on this so you understand the stakes. If you bought a house in 2020 or 2021 when mortgage rates were around 3%, you locked in a payment that is probably affordable relative to your income. But if you need to buy a house today at 7% rates, your monthly payment on the same property is nearly double. A $400,000 house with a 30-year mortgage at 3% costs you $1,686 per month in principal and interest. The same house at 7% costs you $2,661 per month. That is an extra $975 per month, or $11,700 per year. Over the life of the loan, you pay an additional $351,000 in interest. $351,000, because rates are high and staying high. And here is the trap for existing homeowners. If you bought at 3%, you cannot move. You cannot sell your house and buy another one because you would be giving up your cheap mortgage for an expensive one. You are locked in place. The entire housing market is frozen because nobody wants to trade a 3% rate for a 7% rate. This has created what economists call the lock-in effect. Millions of homeowners trapped in properties they would otherwise sell, reducing inventory, keeping prices artificially high, and preventing the normal turnover that makes the housing market function. This is not temporary. This is structural. And the Fed just told you it is not changing anytime soon. Now let me show you the tariff dimension, because this adds another layer of complexity that most people do not understand. The Trump administration just began collecting a temporary 10% global tariff as of Tuesday. The White House is seeking to raise that to 15%. This comes after the Supreme Court struck down Trump's reciprocal tariffs last week, forcing the administration to use a different legal framework. But here is where it gets interesting. Goolsbee, the Chicago Fed president, suggested that the Supreme Court's tariff ruling might actually help cool inflation. If tariffs are reduced or eliminated through legal challenges, import prices fall. That gives the Fed more room to cut rates without reigniting inflation. But there is a problem. The tariff policy is now more unpredictable than ever. Trump responded to the court ruling by implementing new tariffs under a different legal authority. Those new tariffs could also be challenged. Nobody knows what tariff rates will be in 6 months. That uncertainty is paralyzing businesses. Goolsbee described it perfectly. Quote, "The more unpredictability you have, the more question marks that businesses have about policy. The dynamic of low hiring, low firing, which I believe came from business uncertainty, is made even more solidified by adding more uncertainty." End quote. Think about what that means. Businesses are not hiring because they do not know what the rules will be. They are not investing in new capacity because they do not know what tariffs will do to their supply chains. They are sitting on cash waiting for clarity that is not coming. That uncertainty has frozen economic activity. And when economic activity freezes, the Fed's job gets harder because they cannot stimulate an economy that is paralyzed by policy uncertainty rather than by high interest rates. Here is the trap within the trap. If tariffs stay high or increase to 15%, import prices rise and inflation gets worse. That makes rate cuts even less likely. But if tariffs are struck down by courts, the government loses revenue it was counting on, increasing the deficit. And as we discussed in previous videos, foreign holders of U.S. debt are already nervous about American fiscal sustainability. More deficit means more treasury supply, means higher yields, means higher borrowing costs for everyone. There's no clean path forward. Every scenario has negative implications for interest rates and your cost of living. Let me show you what the Fed is actually facing, because the internal dynamics reveal how stuck they really are. At the January FOMC meeting, the committee voted 10-2 to hold rates steady at 350 to 375%. This was the first pause since July 2025, following 3 consecutive quarter-point cuts in late 2025. But here's the important detail. 2 Fed governors dissented. Christopher Waller and Stephen Moran both wanted a quarter-point cut because they saw softening in the labor market. That means there is division within the Fed. Some officials see the economy weakening and want to provide support. Others see inflation remaining sticky and want to hold firm. Waller later explained that he is monitoring stronger than expected labor market data, and that his vote at the March meeting could be a coin toss. His words, a coin toss. That is, the Fed telling you they do not know what to do. They are watching data week by week, trying to figure out which risk is more dangerous. Letting inflation run hot or letting the economy slow down. Neither option is good, and you are caught in the middle. Now let me explain what Fed Chair Jerome Powell meant when he said after the December rate cut that monetary policy is now within a broad range of neutral. Neutral means a rate that neither stimulates nor restrains economic growth. It is the Goldilocks zone where the economy just runs on its own momentum. Powell is saying that rates are no longer restrictive enough to actively slow the economy, but not low enough to actively stimulate it. They are just maintaining the status quo. But here's the problem with neutral. If inflation stays above target while rates are neutral, inflation does not come down on its own. You need restrictive rates to actively reduce inflation, and if the labor market starts to weaken while rates are neutral, you need lower rates to actively support employment. Neutral only works when everything is already in balance, and right now nothing is in balance. Inflation is above target. The labor market is showing signs of strain. Business investment is frozen. Consumer sentiment is fragile. Neutral is not a solution. It is a holding pattern while the Fed waits to see which crisis emerges first. Let me show you what happens when the Fed finally does cut rates, because this is where most people get the story wrong. Wall Street and financial media have conditioned you to believe that rate cuts are good news. Stocks rally when cuts happen. Bonds rally. Housing prices rise. Everyone celebrates. But think about why the Fed cuts rates. They cut because the economy is weakening. They cut because unemployment is rising. They cut because things are getting bad enough that they need to stimulate activity. The Fed does not cut rates in a strong economy. They cut in a weakening one. So when markets price in 3 rate cuts for 2026, what are they actually pricing in? They are pricing in economic weakness. They are pricing in rising unemployment. They are pricing in conditions bad enough to force the Fed's hand. That is not something to celebrate. That is something to prepare for. Because when those cuts finally come, when the economy is weak enough to justify them, a lot of people will have already lost jobs, lost businesses, lost wealth. Goolsbee addressed this directly. He said, quote, "I feel that front-loading too many rate cuts is not prudent. Before we cut rates more to stimulate the economy, let us be sure inflation is heading back to 2%. End quote. He is saying the Fed will not cut until they absolutely have to. And by the time they have to, it might already be too late to prevent significant economic damage. Here is the timeline you need to understand. The government releases the next employment report on March 6th. That is in about 10 days. The Consumer Price Index comes out March 11th. The Personal Consumption Expenditures report comes out March 13th. These 3 reports will determine what the Fed does at its March 17-18 meeting. If employment stays strong and inflation stays sticky, the Fed holds. If employment weakens and inflation falls, we might see rate cut expectations increase. But right now, the probability is 96% that nothing changes in March. That means your borrowing costs stay high through at least mid-year. Your credit card rate stays above 20%. Your mortgage rate stays near 7%. Your auto loan stays expensive. Your home equity line stays costly. Every month that passes without rate cuts is another month of financial pressure on American households. Let me show you who benefits from this situation, because it is not you. Banks benefit. When rates stay high, banks earn larger spreads between what they pay on deposits and what they charge on loans. Their net interest margins expand. Their profits grow. Bank stocks have outperformed the broader market over the past year, specifically because high rates are good for their business model. Bond investors who locked in high yields benefit. If you bought a 10-year treasury paying 4% and held it, you are earning that 4% while inflation runs at 2.5%. Your real return is positive. You are actually growing wealth in inflation-adjusted terms. But most Americans do not own treasuries directly. They own stocks and real estate, which are hurt by high rates. Large corporations with cash on their balance sheets benefit. They can earn 5% on money market funds, while smaller competitors struggle to borrow at 8 or 10%. High rates accelerate the consolidation of wealth among those who already have capital at the expense of those who need to borrow. This is the part nobody wants to talk about. High interest rates are a wealth transfer from borrowers to lenders, from younger Americans who need mortgages to older Americans who own bonds, from small businesses that need credit to large businesses with cash reserves, from families trying to build wealth to institutions that already have it, and the Fed just told you this wealth transfer is continuing. Now let me bring this to your level because this is what matters. Your decisions, your actions, your ability to protect yourself in an environment where rates are staying high indefinitely. First, if you have credit card debt, eliminating it is the single best financial decision you can make. Credit cards are charging 20 to 25% interest right now. There is no investment you can make that reliably returns 20% annually. Every dollar you pay down on credit card debt is effectively earning you that 20% return risk-free. Cut expenses, take a second job, sell things you do not need, do whatever it takes to eliminate high interest debt because the Fed just told you that relief is not coming. Second, if you are thinking about buying a house, understand that waiting for lower rates might cost you more than buying now. Every month you wait, you are paying rent that builds no equity. Every month you wait, home prices might be rising. If rates eventually fall to 5%, you can refinance. But if you wait 2 years for that to happen, you have paid 2 years of rent with nothing to show for it. The math is individual. Run your specific numbers. But do not assume that waiting is automatically the right strategy. Third, if you have adjustable rate debt of any kind, consider locking in fixed rates now. The 10-year yield at 4.05% might seem high historically, but it could go higher if inflation proves more persistent than expected. If tariffs increase to 15% and import prices rise, inflation expectations could increase and bond yields could spike. Locking in today's rates protects you against that scenario. Fourth, if you have savings earning low interest, move that money into high-yield accounts immediately. Money market funds are paying 4.5 to 5% right now. Online savings accounts are paying 4 to 4.5%. If you have cash sitting in a traditional bank account earning 0.5%, you are losing money to inflation every month. The Fed holding rates high is the one silver lining. You can earn meaningful returns on safe liquid savings for the first time in 15 years. Take advantage of it. Fifth, if your retirement is in the next 10 to 15 years, reconsider your stock allocation. High rates put pressure on stock valuations. The risk-free alternative, Treasury bonds and money market funds, now pays 4 to 5%. That makes stocks less attractive relative to bonds. A 60-40 portfolio makes more sense today than it did when bonds paid nothing. Rebalancing toward fixed income in a high-rate environment is not bearish. It is prudent. Let me pull this together because the picture is clear if you are willing to see it. The Federal Reserve is holding rates steady for the foreseeable future. The probability of a March cut is 4%. Fed officials are explicitly saying cuts depend on inflation progress that has not happened yet. The 10-year yield is stabilizing around 4%, keeping borrowing costs high across the economy. Markets are still pricing in 3 cuts this year, creating a dangerous gap between expectations and reality. Tariff uncertainty is adding volatility without providing clarity. Business investment is frozen, the housing market is frozen, and American households are bearing the cost. This is not a crisis in the traditional sense. There is no market crash, no bank failures, no obvious emergency. But that is exactly what makes it dangerous. The pressure is slow and constant, month after month of high interest payments, month after month of unaffordable housing, month after month of wealth transfer from borrowers to lenders. The damage accumulates gradually until suddenly it becomes visible. And when it becomes visible, when unemployment starts rising, when credit card defaults spike, when housing finally cracks, the Fed will cut rates. Everyone will celebrate the pivot. But by then, the damage will already be done. The smart money understands this. They are positioning now for an extended high-rate environment. They are reducing debt. They are locking in yields. They are building cash positions. They are preparing for the economic weakness that eventually justifies rate cuts rather than assuming rate cuts will prevent that weakness. You need to do the same. I am Kenzo John AG. This is Market Acme. Subscribe now and join our WhatsApp community for real-time updates as these developments unfold. Because what happens over the next 6 months, the March employment report, the inflation data, the Fed's decisions, will determine your financial trajectory for years to come. You do not want to be caught off guard when the gap between market expectations and Fed reality finally closes. That is when the real moves happen. That is when fortunes are made and lost. The Fed just gave you a 96% signal. They are not cutting in March. They might not cut for months after that. The question is whether you listen to that signal and prepare, or whether you keep waiting for rate relief that is not coming. The time to act is now, not when rates finally fall. Now, stay tuned, stay informed, and stay ready. Because this story is developing fast, and the decisions you make today will determine whether you thrive or struggle in the months ahead.